The broadcast is now starting. All attendees are in listen-only mode.
So we will present today's session a little bit about us. We are AskPankaj based in Dubai South. We are a team of chartered accountant, lawyers, postgraduates, and tax experts. We are also a registered tax agency having a combined experience of 30 plus years in the organizations like PricewaterhouseCoopers, KPMG, Deloitte. I personally have worked in Coca-Cola as national head of taxation and in Kohler before starting Ask Pankaj. We are advising leading companies in all Emirates. And just before we start, we'll explain the control panel. On the control panel, you can see four buttons. The arrow on the top is basically to expand and collapse the control panel so that you can see the full screen. All of the participants have currently been muted, and we will unmute the participants during the question answer sessions towards the end. You have the Windows key to see the screens in the full slide mode. And then there is a hand button. If you can click on the hand button to raise your hands during the question answer session, we will unmute and you can ask your questions for the live Q&A session. This you have the handout sessions. You can download the handouts for future references, and you have the question box where you can post your queries. We will take up the queries towards the end, or maybe after the webinar if we don't get full time to answer all the queries. We will revert to the answers later on. This webinar is in collaboration with Dubai South for their continuous support and cooperations. We are always thankful to them. We have had before today's webinar, two other sessions live in-person workshops on V80 education series. This is third in series. As you can see that all of us are working from home in terms of the government's directive, but the work from home should not impact our business continuity and the tax compliance. In today's sessions, what we will do is we have basically bifurcated into four sections. We will first do certain tax compliance refresher in terms of even if the ongoing business transactions are not on, there are situations wherein one has to comply with the tax laws. Then we will discuss certain specific transactions which, because of the COVID-19 environment, most of the businesses are facing. We'll go through certain other updates, and then we'll close the sessions with a Q&A sessions for 15 minutes. As you see that COVID-19 environment has severely impacted most of the businesses in terms of the business transactions. The business volumes have reduced drastically, and we all are waiting for the situations to improve. At this time, it is very important for us to note that under the UAE VAT law, there is a requirement to deregister a registered taxable person. So if you are a registered taxable person and from today in your last 12 months, your turnover is anything above 375,000, then you don't need to deregister. However, if your turnover is between 187,500 to 375,000 dirhams, there is an option for you to deregister. It's a voluntary deregistration whether you want to deregister or not. However, if your turnover for the last 12 months is less than 187,500 and you are in the next 30 days also not expecting the turnover to increase within 30 days itself, you are not expecting it to increase to 187,500. And not just the turnover, it also on a standalone basis, if your taxable expenses are not expected to increase in the last 12 months or in the next 30 days 187,500, then businesses have a mandatory requirement to deregister, failing which there will be a penalty of 10,000 dirhams. Whether this penalty would be levied given the economic circumstances is another question. But as per the VAT law, there is a mandatory penalty to not deregister within 20 working days. Another important point to note here is that businesses often cancel their trade licenses and assume they have complied with all the obligations. Cancellation of trade license does not automatically cancel your VAT registration. Even if unfortunately some companies have to close down and they're canceling their business licenses, they need to separately apply for deregistration under the VAT law within 20 working days. What are the effects of deregistration? In case you are holding any goods or services on which you had earlier availed VAT credit, input tax credit, and those assets are still held at the time of deregistration, the business has to reverse that input VAT credit by way of deemed supply. They need to basically pay an output VAT on that value. And hence, it's very important for businesses to identify what are the goods which have been purchased pre-VAT registration, pre-VAT period, that is 1st of January 2018, and post-VAT, that is 1st of January 2018 onwards, and what is the amount of input VAT recovered at the time of purchase, which accordingly has to be reversed. Of course, after deregistration, you cannot use your TRN for any of your invoices, and accordingly, you may have to do the modification in your accounting software and also change the printing stationery. While the deregistration, of course, will reduce your tax compliance cost, the businesses cannot avail and recover the input VAT credit on the purchases from the date of registration, and hence the VAT paid on purchase of goods will become a cost. In terms of tax compliance calendar, we have seen many countries globally and within GCC region deferring the tax compliances in terms of submission of returns, payments, and everything. As of today, when we look, FTA, Federal Tax Authority, has indeed deferred the tax compliance for excise return. The monthly excise return, which was actually due on 15th of April for the month of March, has now been deferred by 1 month, including the excise tax payment to 17th of May. However, for VAT, the FTA website still shows that the tax compliance timeline in terms of submission of monthly or a quarterly return, and accordingly the tax payment is still due as of 28th of April. And in case of failure to submit the tax return within the time frame, there is a penalty of 1,000 dirham for the first such failure and 2,000 dirhams failure in case there is a repetition. And for the failure to pay the tax within the time frame, 2% immediate penalty or interest, another 4% for the next 1 month, and then 1% per day penalty which will be imposed. Again, whether the government will waive it off in terms of the economic circumstances is a separate question, but as of now, there is no deferment of tax payment of tax return, and one has to be careful that they do not get involved in such tax issues by delaying the submission of return or the payment of tax. In terms of business issues, we have seen companies which are into export of goods because a lot of transportations modes have now been put on halt, whether in terms of air, sea, or land transport. There is a requirement under the VAT law to export the goods or put them into a custom duty suspension regime within 90 days from the date of supply. And with all the modes of transport being put on halt, a question comes whether there can be an extension of time to export the goods while we recognize the sales revenue or exports revenue in our books of accounts today, especially with 31st March being the year close for many of the companies. Similarly, a lot of companies do have monthly or a quarterly tax periods, which involves, of course, the administrative work to prepare the tax return and cash flow for the tax payments. And a lot of companies have been inquiring us, is there an option to change from monthly to a quarterly tax period or from a quarterly to a half yearly tax period? The answer is yes. There is a process called administrative exception, wherein the businesses can apply to FTA. It's a form available on the FTA website. Two categories of such administrative exception is actually to seek an extension of the time to export the good beyond 90 days, and also the change of tax periods. One can apply depending on their taxable turnover quantum from a monthly tax period to a quarterly tax period. And in selective cases of a small and medium scale enterprises, FTA can also convert the tax period into a 6 monthly, that is half yearly tax period, which obviously helps you in both cash flows and the administrative work of tax compliance. Just for the purpose of information, the other categories for which administrative exceptions can be obtained is on the tax invoice and tax credit note in terms of exception to mention all the prescribed particulars. The tax stagger in terms of if somebody has a quarter of February, March, April and want to change it to January calendar quarters of January, Feb, March, they can apply for the administrative exception. There is also a new category of administrative exceptions which FT has introduced, which is the evidence or the documents to prove export of goods. As you recall, in our previous webinars, we have discussed that two specific documents required is official and commercial evidence for zero rating of export of goods. And now FTA is allowing companies to apply for exceptions, and on a case-by-case basis, they would approve such exceptions based on the quality and the verification of the alternative documents. Now, before we move on to a second category in terms of transactions on the COVID-19 environment, we would like to have just one quick poll to understand the audience view. You would see a question on your screen as to what would be your primary focus upon resumption of economic activities and business operations. The primary focus would be business development, operational reforms and restructuring, or tax compliance. We have 30 seconds for the participants to click on the options. It's a multiple selections. You can select any, all of the options available. We close the poll in another 20 seconds. 10 more seconds, requesting participants to more than 80% of the participants have already voted. So sharing the result of the poll, if you can see on your screen, about 59% of the participants feel the primary focus would be business development, which is obvious. And 55% of the participants also feel that the operational reforms and restructuring would be the primary focus, and 41% participants feel that tax compliance remains to be the primary focus. Of course, it's a tax compliance, a tax webinar, so I'm assuming that's why tax compliance is heavy on everyone's mind. The point that we are trying to convey and make is that VAT by nature is a transaction-based tax. There is no special set of transactions which the organizations are undertaking under the COVID-19 environment for which the government can announce a special VAT treatment. In terms of the resolve and resilience of businesses on terms of current environment and current environment challenges, in terms of return and reimaginations of the new business reality once this pandemic is over, and reform of the business activities to kickstart all the business operations once again, each organization will be adapting to new and innovative transactions. And again, as VAT is a transaction-based tax, the VAT consequences of your innovative and new structure models would automatically follow. And that would be the focus of our next section of the presentation, that specific transactions which businesses are taking what are the VAT compliances point and risk relating to that. Now, if you look first is the input VAT credit on all the purchases that businesses have been making in the past, receiving the invoices, they have been recovering the input VAT, the eligible input VAT credit. The two conditions to avail input credit is to the receipt of tax invoice and the payment to the supplier or the intention to pay to the supplier within 6 months of the due date. So if you look at the timelines, we have receipt of the tax invoice, which basically satisfy condition number one. Whenever the purchaser forms the intention to make the payment, the condition two satisfy and they recover the VAT credit. But because of the ongoing environment, assuming more than 6 months have lapsed from the due date, not from the date of invoice, but from the due date of the invoice, more than 6 months have lapsed and the payment is still not being made. This will automatically require businesses to reverse the input VAT credit. So that's a hit on your cash flow as the buyer because you'll have to reverse the VAT credit. Now, the option one businesses can explore depending on a specific cases is to negotiate and agree with the suppliers for a credit period extension and formally agree on a new due date so that as a condition the buyer can satisfy that they have the intention to pay the invoice within 6 months from the agreed due date with the supplier. Looking the same situation from a supplier's perspective, in case suppliers have issued the invoice, of course, in terms of date of supply, they have already accounted for output VAT, even if no recovery has been made for the buyer. And because of the unfortunate circumstances in terms of the economic hardships, there might be a situation that more than 6 months have passed on and the buyer has still not paid for the invoice, and there might be a situation of a bad debt. In such situations, when it is known that you cannot make the recovery of any of the invoices that you have issued in terms of supply of goods or services, there is an option to recover back, that is, improve your cash flow by claiming a bad debt relief. The three conditions for claiming the bad debt relief is that you should have written off the debtors in your books of account. You should have notified the buyer, the recipient, that the amount has been written off, and more than 6 months have passed since the date of supply. Please note it's very, very important that you should have notified the recipient that the amount has been written off. In other words, you do not then retain a legal right to enforce that debt and recover. And that's why it's very, very important to understand the difference between a write-off and a provision for bad debts in your books of account. If you are still chasing for the debt and you have still not written off the bad debts in your books of account, please do not claim the bad debt relief because that will be in violation. Only if you are writing off the debt, at least the 5% VAT which you have paid on it earlier can be recovered. The other two issues that needs to be considered is the bad debt before the 6 months period, in which as condition number 3 you can see on your screen that to claim the bad debt relief, minimum of 6 months should have passed since the date of supply. But in case a business, in terms the buyer's business has already closed down, there is a certainty that the buyer will no longer pay. One has to still wait for the 6 months to pass for claiming the bad debt relief. The mere fact before 6 months you have written off the bad debt does not entitle you to claim the bad debt relief. Another interesting point that comes and often has been asked by the clients and companies is what if there is a bad debt, but we do have the debt insurance and the insurance companies pays us for that debt. So while as the contracted debt, you as a supplier has still not received the money, but you have been compensated by the insurance company and through the indemnification. That's a specific case depending on your insurance contracts and the wordings of the insurance contract. One needs to see whether the insurance company is making the payment on behalf of the buyer or it's an indemnification payment, in which case VAT on that indemnification payment may not apply and you would still be applied eligible for bad debt relief. We have cases where, be it a factory, the retailers or traders, the restaurants and shops have a stock of raw materials, semi-finished goods, and finished goods. And because the business activity has been put on hold, we have all been witnessing that malls have been closed down. So there would be a situation that on the resumption of economy and business activities, certain stocks would have to be written off or disposed of. And that leads to a question, what are the VAT implications? Now, a stock write-off or stock disposal can happen in different scenarios, taking each scenario one by one. If you are disposing of any stock for a consideration, even if you are scrapping it at a scrap value, there is a requirement to charge output VAT on the scrap value. One cannot claim that this is not a sale to our regular buyers, this is not a sale in course of our regular business activities. It's the damaged stocks or the expired stock we are selling or we are disposing of at a scrap value. One still needs to pay VAT on that scrap value. The sale at a loss is not prohibited under the VAT law. So many a times companies and people have this question that we purchased it at 100, we recovered VAT credit, input VAT credit at 100 purchase value, but we are reselling it or disposing it off at 10 or 20, and hence do we need to reverse our input VAT? As we said, VAT is a transaction-based tax, so long as it's a genuine business transactions, there is no prohibition to sell at a loss. In a scenario when you are disposing of the stock without consideration, that leads to a question whether such disposal would amount to a deemed supply, that is a supply without consideration but still taxable under the VAT law, and whether you have an obligation to reverse input tax credit. Because in a way, you purchase those stocks, recovered the input VAT credit, but you are disposing of those stocks without any value, and hence a question arises whether it's a deemed supply. Again, there is no straitjacket answer to this. It depends on each individual case. What are the circumstances of the disposal? To which party are you disposing? And what is the usability of the goods which you are disposing without consideration? Based on which a case can be made whether it's taxable or not. And businesses can accordingly follow that position. In a scenario when you are writing off the inventory in the books of account, but the physical inventory still remains with you, there is no requirement to reverse the input VAT credit or pay an output VAT on the write-off. But what is important is that the subsequent usage or disposal of the goods after the write-off needs to be monitored. That is, after write-off, if you are still disposing it off at a scrap value, VAT would still be payable on that. For companies which are based in designated zones or free zone where they have also availed custom duty exemptions at the time of import of such raw materials or traded items, and then they are writing off or disposing it off, they need to make sure that the compliance under the customs law is also taken care of, be it in terms of payment of customs duty on such disposal or maintaining the customs documents required to ensure that you have the full track of the goods that you are disposing of. We have seen many governments and providing price support or subsidy, and we would also see on the resumption of business activities that to clear out the stocks and increase the sale, there would be a situation that companies will give price support to their customers, dealers, and retailers. So, take an example, there is a car dealer who has been promised by the manufacturer a price support to clear out the stock and promote sales. And let's take an example that 20,000 dirham for per car sold is the price support to be given. And accordingly, the consumer only pays 80,000 plus VAT for the purchase of car from the retail dealer. Now, there are two ways one can argue the VAT should be calculated. One is, as you can see on the screen, on the 1,000 dirhams, charge VAT first and then reduce the price support which has been given by the manufacturer. And second, use or treat this price support as a discount in option number 2, reduce it from 1,000 and charge VAT on only 4,000. And this is where the provision of VAT law and its understanding becomes important. We have Article 28(2) of the Executive Regulations, which says that the value of supply may be reduced by the discount, but that supplier should have funded the discount. In the example given on the screen, you can clearly see that the discount has not been funded by the car dealer who is the supplier, but it has been funded by the manufacturer, and accordingly, the VAT should be calculated on the total gross value, and then the price support should be reduced in terms of what is to be recovered from the consumer. This is a common concept of subsidy or a third party consideration across the globe. So it's not something which is peculiar to the UAE VAT law, but this provision is applicable across the globe because the VAT principles are same. The copy of the executive regulations decree law is available on the handouts. You can download it for your future reference. We will also see in this environment that businesses will be supported by the government. Now, in terms of the support of the government, whether the same financial subsidy or assistance will be subject to VAT will depend whether it's in terms of funding the discount to be given to the consumer, or it's a overall or a lump sum subsidy to be given for resumption of business activity, and hence the nature of financial assistance or subsidy will determine whether VAT is payable on that or not. Bear in mind, even if this price support from the manufacturer or the brand owner is coming from outside UAE, the applicability of this discount and valuation principles remain the same. So just because you may or may not have accounted for reverse charge on the price support from outside UAE, when you are selling to the consumer, if you have not funded the discount, the VAT should be calculated on the gross value. We have seen in this COVID-19 environment that rent-free periods are being offered by the landlords and by the developers. And of course, the properties are divided between commercial properties and the residential property. Commercial property, which in general are taxable, the rent-free period and the corresponding VAT implication needs to be examined depending on the nature of rent-free period and when it has been given. So if the rent-free period has been given during an ongoing lease, it's in the nature of discount. The supplier can reverse the output VAT which would have earlier charged on the invoice or the payment by issuing a tax credit note, and the lessee will have to reverse the input VAT credit that they would have recovered earlier. However, in case the rent-free period has been given after the expiry of lease, that lease has expired. However, because of the lockdown, the businesses cannot move, and hence, or the resumption, another 2 or 3 months have been given to test the viability of the business. An issue of deemed supply could arise, that is, a supply without consideration but still taxable, and therefore your contracts and the negotiated terms for such rent-free period after the expiry of lease will determine whether VAT is still applicable on the rent-free period. Similarly, if a free extension has been given to vacate the premises after the lockdown is over on the resumptions of the operations, the obvious question would be whether that rent-free period is a deemed supply, and does the lessor or the developer still needs to account for output VAT. But if it's an ongoing lease and a rent-free period has been offered, that's certainly a discount, and the output VAT on it can be reversed. When it comes to residential property generally are exempt except the first supply, which is zero rated. And in such cases, the rent-free period will only leads to a questions for the supplier whether they are eligible to avail the input VAT credit on the common expenses, and what would be the basis or the formula for input tax apportionment, what should be the value that should be recognized for it. And hence, even if it's an exempt property and you are offering a rent-free period, please do not assume that there is no consequence, VAT consequence, and you can just simply carry on with your business activities and the tax compliance. You need to focus on the input tax apportionment if you are leasing out the residential property. And that leads to also a question on the labor accommodation, whether labor accommodation, which is generally exempt as the residential supply, whether what should be the input tax apportionment. Also, the question in labor accommodation would be, and especially for people who are either availing the labor accommodation, that any lease for less than 6 months, if you are taking a labor accommodation for less than 6 months, it could still be taxable as 5%, because what is exempt is only lease for more than 6 months. And hence, if the labor accommodation supplier charges you 5% VAT, as the receiver, can you avail the VAT credit of that 5%? Is a question that you need to examine. We would see, and we have seen a lot of analysis reports by the big consulting companies, that post COVID-19 globally, the economy will witness mergers, consolidation, amalgamations of business entities, and perhaps sale of one business entity to another business entities. And a question comes that on such mergers and sale of business entities, whether VAT would still be applicable. The VAT law specifically provides that a transfer of an ongoing business for the purpose of its continuation by the taxable person is outside the scope of VAT, that is, no VAT is applicable. So, in case you are merging or selling the ongoing business entity to another one, there is no requirement to charge VAT. But what you need to make sure is understand the difference between asset sale and transfer of business. If you are selling your assets individually, maybe to the same buyer, but in terms of a contract, you are basically listing down the assets, that these are the assets I am selling at this value, then it may not amount to a transfer of going concern and transfer of business, and your VAT would still be applicable on the sale of assets. And therefore, it's very important to understand also and examine the status of your ongoing business operations, whether it will be continued or after the purchase of business, the operations will be discontinued, and what are the contracts and documentation that you have kept to demonstrate that it was indeed a sale of business, will determine your VAT liability. There is already a VAT, a detailed guidance issued by FTA on the transfer of business as a going concern. It's available on the FTA website. You can go through in detail to understand what are the points to be taken care of. Over the last 2 years, we have obviously debated, discussed, we have covered it in our previous webinars also, the difference between disbursement and reimbursement. Reimbursement by nature is a recovery of expense that the supplier incurs as a principal. So if we are providing a tax consultancy services to a client and we seek a reimbursement of our travel expenses, then that's the reimbursement, because those travel expenses we have incurred as principal. On the other hand, disbursement by nature is the recovery of payment made on behalf of another person. So, to the same client to whom we are providing tax consultancy services, if we have paid any business license renewal fee on their behalf and we seek the recovery of that renewal fee, that's purely a disbursement, because that payment was made on behalf of the client. Accordingly, the reimbursement amounts are taxable as per the main supply. However, the disbursement is outside the scope of VAT. So, one of the situations that we came across recently is that we have company A and the employee of company A. However, company A does not have the online banking facility to pay the salaries to its employee. So what it does, it contacts another company, which is actually a related company, but not in the same tax group. And the company paid the salary to the employee through their bank account and then recovered this amount from company A. This recovery of money is purely disbursement and will not be subject to VAT because this salary payment to the employee was on behalf of company A. And therefore, any payment that you are making or you are required to make on behalf of somebody else, please examine whether it's a disbursement or reimbursement, and accordingly, the VAT consequences will follow. The similar principle in terms of disbursement and reimbursement is also applicable on the expenses incurred by the employee, because most of us are actually working from home, and hence it's obvious that the employees are actually incurring some expenses on behalf of the company because they are working from home, and eventually they will seek a reimbursement claim from the company. And this is where you need to distinguish. Let's take scenario one, where you give a fixed allowance to the employee, and the employee incurs out of that fixed allowance and then later on submits the bill just for the purpose of proof that this allowance has been spent by the employee, versus the scenario where the employee first incurs an expense and then submits the bill for the reimbursement. I'm using the word reimbursement though, that this is the expense which has been incurred by me on behalf of the company. Of course, employees are not taxable person. We are not talking about the taxability in hands of the employee. But in the first scenario, when you have paid a fixed allowance to the employee and you are not actually bothered in terms of the actual expense incurred by the employee, the company cannot recover the input VAT credit on such purchases. On the other hand, if you are reimbursing the employee of the exact amount which they have incurred on submission of the invoices, the input tax can be claimed by the company. Obviously, the fact that the invoice received from the supplier and submitted by the employee, are they valid tax invoices in terms of invoices more than 10,000 dirhams? Does it contain the name and TRN of the company? Those are the points you need to educate your employees and make sure, because that's the other legal compliance, that purchase invoices more than 10,000 dirham need to have your name, mailing address, and TRN mentioned on it. In terms of the guidance video on the tax invoice, you can again check out the handouts. We have provided certain links to the video we have uploaded on YouTube on the validity and the necessary particulars to be mentioned on a tax invoice. Now assume this supplier is based outside UAE. An employee is making the payment through their credit card, be it a purchase or a subscription of a software, or maybe some purchase of the goods coming through courier. Question is whether on these payments reverse charge is applicable. In scenario one, when the employee has got a fixed allowance and the nature of expense is not a concern for the company, then the reverse charge may not be applicable. However, in the second scenario, when the employee is seeking a reimbursement of the expenses incurred on behalf of the company, reverse charge would be applicable. So even if as an accounts team, finance team, you are seeing that we are not paying, or the company is not paying to the foreign supplier, we are only paying to our employees locally, please do not commit the mistake of not accounting for the reverse charge. The reverse charge would still be applicable even if the company is not directly remitting the amount to the foreign supplier. Of course, with again in the COVID-19 environment, we have seen a surge in the e-commerce transactions, and through delivery platforms, the deliveries are being organized and delivered to the customers. So we have situation where consumer places an order on the e-commerce platform, which is then passed on to the retailers, including the restaurants, and the goods are delivered. So while the consumer pays, let's say, 1,000 dirhams to the e-commerce platform, the e-commerce platform retains 100 dirhams as their fee and remits 900 dirhams to the supplier and the seller. Question is that whether the goods have been supplied by the retailer or by the e-commerce platform. The answer is e-commerce platform is only acting as a mediator for facilitating the order confirmation. It is not buying the goods from the retailer, it is not selling the goods to the consumer. The retailer is directly selling the goods to the consumer, and hence it's a requirement that retailer should charge VAT on the full 1,000 dirham. Merely because you are receiving 900 dirhams from the e-commerce platform does not entitle you to charge and pay VAT on 900 dirhams. The retailer, again repeating, is required to account for VAT on the 1,000 dirham. The e-commerce platform in turn will actually issue you a tax invoice for the 100 dirhams, and you can recover the VAT charged by the e-commerce platform on such 100 dirhams. We thank Dubai South once again. Thank you once again to take our time this morning to attend this webinar, and we will announce our next webinar. For all the queries which has not been answered, we'll take the stock of the queries and approach you separately. Thank you once again. Thank you. Bye-bye.